Today we've got a hot topic on our hands, the upcoming Bank of Canada meeting and what that might mean for our economy. We'll be breaking down the recent developments and data to give you our take on whether the Bank of Canada is likely to hit brakes on interest rate hikes. Before we dive into our prediction, let's catch up on what's been happening in Canada's economy. The highly anticipated second quarter GDP report is just around the corner, and the word on the street is it's not looking as rosy as before. According to Reuters' poll of economists, we're expecting to see a significant slowdown in the economy growth. The GDP growth rate for the second quarter is predicted to drop to 1.1%, down from the impressive 3.1% we saw in the first 3 months of the year. Now, here's where things get interesting. The Bank of Canada is scheduled to make their next policy decision September 6th, and the upcoming GDP report is playing a crucial role in shaping that decision. With expectations of slower economic growth, there's growing buzz that Bank of Canada might pause on their interest rate hikes, which were climbing quite rapidly over the past year and a half. Hold on, because it's not all black and white. Even though the economy might be tapping its brakes, the latest Consumer Price Index, or CPI report, showed inflation rising above 3% in July. That's a bit of a headache for Bank of Canada since it's moving away from that 2% target. This puts them in a tricky situation. Do they keep rising rates and curb inflation, or do they pause and support economic growth? Most experts highlight how important this GDP report is for the Bank of Canada's upcoming decision. The bank's been all about data dependency, and they're not closing the door on more rate hikes just yet. But wait, there's more to this story. Some of the slowdown could be attributed to temporary factors like wildfires, energy project maintenance, and even civil servant strikes. And here's the twist. The preliminary estimate for July's data is set to release on the same day as the quarterly GDP data, and this could play a big role in shaping rate outlook. So what's the probability of the Bank of Canada hitting the pause button? Well, money markets are giving it a 70% chance, but they're not ruling out tightening later in the year, with interest rates potentially peaking at 5.25%. That's something to keep an eye on, especially if you're looking to buy or refinance. And let's not forget about the external factors. We've got a recent dock worker strike and the contraction in June actively adding to this mix. These elements could contribute to a negative GDP print for the third quarter, making things even more intriguing. As the Bank of Canada's projection for the third quarter matches their second quarter estimate, it's a waiting game to see whether they'll maintain their course or adjust their sales based on the incoming data. I know that was a lot of info, but the good news is you're all caught up. The Bank of Canada's upcoming decision is truly a balancing act between economic growth and inflation. Will they hit the pause button on interest rate hikes or keep their foot on the pedal? We'll find out soon enough, and remember to subscribe and hit that notification bell so you don't miss our follow-up video on the aftermath of the Bank of Canada meeting. Until then, stay informed and stay curious.